Welcome to Skilled MBA Case Study Series in Accounting. Imaam Spinning Mills, a private textile company, needed to calculate its weighted average cost of capital, WACC, for strategic expansion. Without stock market data, they relied on industry benchmarks and comparable public companies to estimate the cost of equity and debt. This approach was crucial for evaluating the financial viability of expanding into weaving operations. On the 2nd January 2018, Imaam Spinning Mills confronted a strategic decision. The CEO suggested expanding into weaving operations. The key question was whether this investment was financially viable. This required a thorough analysis of potential returns and risks, ensuring the expansion aligned with the company's long-term financial goals. The chief financial officer must rigorously assess the investment's feasibility. Calculating weighted average cost of capital is challenging without public stock data. To evaluate potential returns, calculating net present value and internal rate of return is essential to determine if weaving operations will add value to the company. Understanding WACC is crucial for evaluating investment feasibility. It represents the minimum return needed to satisfy investors, blending equity and debt costs. Key components include EV for equity proportion, RE for cost of equity, DV for debt proportion, RD for cost of debt, and TC for corporate tax rate. Imaam faces the challenge of lacking stock market data, making it difficult to directly observe beta. This absence complicates the calculation of the cost of equity. Additionally, Pakistan's textile sector presents unique risk characteristics that must be considered when assessing financial metrics. To estimate Imaam's beta, identify listed textile firms in Pakistan with similar operations. Unlever their beta to remove financial leverage effects. Then, relever using Imaam's debt-to-equity ratio. This approach provides a tailored beta, reflecting Imaam's unique financial structure and industry risks. The chief financial officer identified publicly listed Pakistani textile companies with similar size and operations in spinning or weaving, ensuring comparable business models and reliable market data. This benchmark aids in accurately comparing Imaam's operations, setting the stage for further financial analysis. The chief financial officer calculated the unlevered beta by removing financial leverage from the comparable firms' betas. Using the formula VU Shakurius VL Shakius 1 plus 1 T DE, the average unlevered beta was determined to be 0.78. This metric provides a clearer view of the firm's inherent business risk, excluding financial structure influences. To determine Imaam's beta, the chief financial officer relevered the average unlevered beta using Imaam's debt-to-equity ratio of 0.80 and a tax rate of 30%. This adjustment reflects Imaam's specific financial leverage, providing a more accurate measure of the company's risk profile. Using the Capital Asset Pricing Model, CAPM, we calculate Imaam's cost of equity. The risk-free rate, based on the 10-year Pakistan investment bond, is 7.5%, with a market risk premium of 7.0% and a beta of 1.02. The cost of equity is determined to be 16.04%. To derive Imaam's final weighted average cost of capital, WACC, we consider the capital structure, equity at 55% and debt at 45%. The cost of equity is 16.04% and the cost of debt is 9.5%, with a tax rate of 30%. These components are crucial for calculating the weighted average cost of capital, which influences investment decisions. Analyzing investment feasibility involves assessing the initial capital needed for the weaving plant expansion. The discount rate, represented by the weighted average cost of capital, evaluates future cash flows. A positive net present value indicates value creation beyond investment costs, while the internal rate of return, surpassing the weighted average cost of capital threshold, confirms the project's financial viability. Private firm valuation requires using comparable firm proxies when direct market data is unavailable. Estimating beta involves unlevering and relevering to establish accurate risk measures, Strategic finance connects weighted average cost of capital to business expansion decisions, ensuring financial modeling aligns with growth objectives. Imaam's decision to invest in the weaving plant was driven by a positive net present value and strong internal rate of return. By January 2020, the plant was operational, effectively diversifying revenue streams. This investment exemplifies how a robust financial methodology can guide strategic decisions even in the absence of public market data. Thank You and Skilled MBA simplifies complex business decisions into actionable insights. Our approach empowers leaders to make informed choices with confidence. For further assistance, reach out via mobile, email, or visit our website.